And with that, I'm going to hand it off to this panel. I want to first introduce Ernie Caballero, CIO for UPS, John Glidden, CIO for Delta Airlines, Stephanie Lang, CIO for Homer Berg, Muthu Mathia, CIO for Children's Healthcare of Atlanta, and the panel will be moderated by Emily Hilton, Senior Vice President for Cowen. If you can give them a warm welcome, I'd really appreciate it.
It's good to see everybody here. Thanks for being with us. And before we get started, and this is a great panel, I do want to thank two individuals, Robert Thompson and Kathy Ford. They have just done an outstanding job with putting together panels and information for the CFA Society of Atlanta this year. So maybe we just give them a quick round of applause. Especially since Robert just asked you to attend an AI panel and to grade papers. So, all right. I want to kick off the panel today, and you heard who's here with just one, if my calculation is right, one tidbit of information. I think collectively these four individuals are responsible for over 120 billion in assets as allocators of those assets. So it's pretty powerful panel here. I'm sure I missed all the ancillary plans, but the big plans I think account for about that. And we have representatives obviously from corporate pension, corporate defined contribution plans, endowments, foundations, as well as ultra high net worth. So think about that as you're asking your questions. And we will have a couple audience participation questions at the end. So if you have not been tracking the markets, and don't do it certainly during the panel, but if you have been tracking the markets, try to think back over the last couple of days for numbers. So let's go ahead and get started. I'm going to start with Ernie and just spend a couple moments on your not your background, but what you manage, and I think just a little bit about maybe how your team is structured as well.
Okay, you guys hear me okay? Yeah, so Ernie Caballero, UPS, and what my team and I are responsible for is managing our defined benefit plans in the US. And there's three big ones that we have. And one of them is closed and frozen. The other two are wide open and accruing. And we have a team of about, over those three plans, I want to say it's just under 30 people. And we're kind of split up as we have 4 MDs, one over ops and compliance, one over risk and strategic asset allocation, one over public markets, which includes fixed income, and the other one which is over private markets. And then we have PMs and analysts that are beneath all of those, split amongst the common asset classes that you all know about. What we've done differently over the past couple of years is we've adopted more of a liability-aware approach. Prior to that, it was growth only, and I can talk to you for about hours why we did it and why it's important, but at the end of the day, we're more liability-aware, so we have about 50% in fixed income, and we have a hedge ratio of about 80%, so synthetically another 30% of fixed income, but synthetically with a duration overlay that sits on top of that. That manages keeps the fund status volatility in check, and we let the risk premium of the other asset classes grow some of the funding gaps that we have.
Hey, John Glidden with Delta Airlines. So another corporate plan. We've been frozen so we got a defined benefit pension plan that's $15 billion, been frozen for a long time, so not accruing anymore. We've got two objectives with our defined benefit plan. One is to make a 7% total return target. If we don't do that, that's bad stuff for corporate earnings and for cash flow. So we do care about our 7% total return target, and then like Ernie said, we want to gently, continue to gently grow our gap funded status and not backslide too much. I think many people probably know the Delta story in the room. Deeply underfunded. We've come all the way back, fully funded. We don't want, it was too hard to get here. We don't want to have to go through that story again. On the defined, so these two objectives can be in conflict, right? And we've seen that over the last couple of years. If bond yields go up and bond prices go down, it makes it awfully tough to hit your 7% return target. I do invest like an engineer, so our portfolio might look a little bit different. We're 25 to 30% privates, pretty much of all persuasions. We're 40 to 45% hedge funds. We have a couple of small Portfolios outside of that, a little bit of Risparity, a little bit of LDI, a little bit of an emerging manager, some inflation. And we trade a lot of derivatives. And those derivatives are mostly fixed income derivatives. And happy to talk about this more, but I like to stack as a non-taxable investor. Doesn't work for taxable folks out there. I like to stack returns on top of each other. I like bonds exposure. I hate using capital on bonds. It's not, per unit of capital, it's not a great deployment. But if you compare bonds with hedge funds, I think you're really onto something. So that's the defined benefit side. We can get into that. 401k, that's $30 billion, growing quickly. Happy to talk about any of that kind of stuff. Our target date fund, we are a client of, we do a little bit of a custom target date fund all through BlackRock, 40% active, 60% passive. Try to keep expense ratio around 10 basis points, and it helps to have scale. That's Delta.
Can y'all hear me? Okay. So I'm Stephanie Lang, and I'm the Chief Investment Officer at Amrick Berg. We're a wealth manager in Atlanta, been around since 1989. We have about $14 billion in assets. We manage primarily high net worth individuals, but do have a smaller institutional business as well. We're managing the asset allocation and the manager selection for all our clients. That's specific to the goals of the individual or institution. And so we use a range of products, ETFs, mutual funds. We also manage some internal strategies. We have a dividend growth individual stock strategy. We do direct indexing in-house, and we also buy individual bond portfolios. So we're focused on keeping those costs low. We also, on the private side, we manage internal fund of funds to give our clients access to private investments. No extra fees there, just trying to get access for our clients. And then we also manage a hedge fund of funds that we've had since 1999. So big emphasis on private investments as well.
Can y'all hear me? Hi everyone, Muthu. I work for Children's Healthcare Atlanta. We're about a $6 billion portfolio now, 11-person team. Our capital is in service of our mission, and Children's mission is to make kids better today and healthier tomorrow. So we have a dual mandate based on the two words, today and tomorrow. We provide a backstop for today's spending, and we compound capital to preserve purchasing power for future generation of Georgia's kids. The way we kind of approach asset allocation is very broad. We have a 70% allocation to equity-like investments that we think provide us compounding, and then we have 30% allocation to fixed income-like investments that we think provide us liquidity and protection. What that really means to us is that we target a 0.7 equity beta over time for the portfolio. That helps us meet both of our mandates, and then we just allocate every unit of beta we can to the highest alpha potential that we see. We think that because we don't have the asset class buckets, we change the question that we ask ourselves. We think if you're thinking in asset class buckets, you're forced to ask the question of how to own something, which is very important. But if you take away the buckets wholesale, you're forced to ask the question of what to own. And given we have infinite duration, the ability to take a lot of volatility, and the ability to take a lot of illiquidity, our laser focus is on owning high quality, long duration assets that are sourced in inefficient markets and benefit from innovation.
I love that, sort of reframing asset allocation by what should you be forced to own. That's great. You should take that back to our firm. So there were three themes that I picked up on. One was the value of diversification. Every one of these individuals spoke a little bit about diversification. In doing so, the importance of asset allocation and how you think about asset allocation came up. And certainly the third one is risk management. And instead of going into those three right now, I do want to ask a question to each one of the panelists about risks and opportunities in the market today. You've talked about the framework for managing your asset pools, but what sort of risks and opportunities do you have in the market today? Muthu, maybe I'll start with you.
I was hoping you'd start with Ernie, and I could just comment. So our focus again is on inefficient markets and on innovation, and we define innovation pretty broadly. It's just not tech innovation. It's business model innovation, it's a lot of different things. So looking at it through that lens, we think there's still, you know, if you put those two vectors together, we think opportunity-wise, it leads you to kind of four places. India and China. China is a very big debate internally and externally. Technology and biotech. So because we don't have the asset classes, we kind of run those four themes in the portfolio. So we think there's still opportunities in those four buckets. And then each of those buckets, I think, has a different set of risks. I think in India, it feels like the biggest risk is valuations and how expensive markets are right now. In China, I think we all understand what those potential risks might be, but it's geopolitics, it's what happens if they can't kind of restart this economy. Within technology, I think the risk Ernie and I are talking about is valuations again. And within biotech, it's always science is the big risk. And so in that bucket, we only do long short because we want to benefit from both sides of that trade.
So in terms of how we look at opportunities and risks, we do take a macro outlook to see if we want to dial up or down risk, and a lot of that has to do with whether we think the risk of recession is up and how does that affect the market going forward. That being said, it's tweaks around the edges to asset allocation. It's not wholesale changes. But if you look at what's going on right now, you know, within the macro environment, I have to say that, you know, we've obviously had a good run in the market, and there's been a number of headwinds that have been kind of taken off the table, if you will, or things that have surprised the market and really led to what we've seen as a big rally. So, you know, obviously, the Fed is the big talk today. We have the Fed meeting later today. And, you know, I think one thing is clear, that it looks like the Fed is done. And so that's a nice headwind that's been taken away. We're not going to continue to see these upward movements in interest rates. Inflation, you know, it was a high in the summer of 22, over 9%. We're now down to 3%. So, you know, right direction on inflation. And can we get that extra percentage point to get to the Fed target? That's, you know, what's really going to be the focus of Powell's comments, and what is the trajectory from there. And then employment is really, you know, been stronger than anyone expected, including the Fed, and that's really allowed us to, you know, have this sequence where inflation has come down before employment has ticked up and kept the consumer strong. So I think it surprised us and, you know, a lot of market participants to see, you know, the economy hold up so well. But if you look into 2024, you know, we're a little bit concerned about how things can transpire. I think everyone's excited. We've seen this big rally in the market, but we also have seen the market price in, you know, number of rate cuts, 4 to 5 next year. We think that's optimistic. Again, we'll see what Jerome says today. So I think that's a little bit zealous in terms of what we would expect there. So that's something that, you know, might have an effect on the market. Earnings estimates for next year over 12%. I think that's a little bit optimistic again. You know, we had 3 straight quarters of negative earnings, and so now it's expected to, you know, jump right back up. And with inflation coming down, there's not going to really be the pricing power, but, you know, interest rates are still high, and we are having to employ employees a lot, you know, an average 25% up from 2019 levels. So that's a big number there. And then, you know, the other thing we're concerned about is valuations, 19-time forward earnings, and that's something we're concerned about. And, you know, a lot of that's driven by the Magnificent Seven, if you will, with over 30 times earnings. The rest of the market's still, you know, at 15 times. So all this to say, we're a little bit cautious about going into 2024, and what that means for our portfolios is that we've had a little bit of a risk-off stance, and that means, you know, substituting some equity risk for high-quality fixed income and private debt, which we think has been attractive. Like what we like to say is take what the market gives us, and the market has given us these higher, you know, rates than we've seen in quite a long time. And what we also like to tell our clients is that Time in the market is a better strategy than timing the market. So, stay invested. There's always clients have different reason to be scared, and I think everyone's pretty exuberant right now. But I think there's going to be that lagging effect from interest rates. People are going to have to move. You're going to have to buy cars. Companies are going to have to refinance, and everyone kind of sees what happens when real estate investments are trying to get new debt. That doesn't work either. So I still think there's still some ripple effects from interest rates increases, and that's something we're going to be watching. But so far, so good. We're happy employment has stayed strong, and we welcome the rally. So.
All right, so I'm going to start really high, and then I'll try to bring it down a little bit. It's been an amazing 40 years. As we've seen interest rates come down a lot. I can talk about other stuff, low tariffs, low taxes, all kinds of stuff, globalization, immigration. That's been great. I think that's led to low and steady inflation. I think it's led to high in rising margins. And there's been winners and losers, and the winner was the S&P 500. Right? So if you're in the S&P 500 for 40 years, congratulations, that is phenomenal. And there was also losers. Losers was diversification. If you diversified at all from plan number A, you didn't look so smart, and you didn't look so smart for 40 years. Right? So I mean, that's a long time to say that you were early. So what Stephanie said about, we're institutional investors, this is all kind of stuff at the margin. But I will say what many, many people have said before me and have really been dead wrong on, and that is I do think we are entering a different time. The biggest reason I think we're entering a different time is that we've got the kind of the pendulum swinging towards populism across the globe. And one way to think about this is Republicans have lost they've lost fiscal discipline when they're in power. They have it when they're in opposition, but not when they're in power. And Democrats have lost the taste for tax cuts. Right, so there is no spending discipline, and there are no new sources of revenue, and that leads to a 6% deficit in a year when there's not a recession and the U.S. is not directly involved in a war. There's no pandemic. Historically, very unusual. And there's consequences of this, right? I mean, this is what I think the natural rate of interest rates have gone up a little bit. I think the natural rate of inflation has come up a little bit. For a long time, we've seen low and steady inflation, which meant that growth and growth surprises have really been the dominant driver of asset class returns. I think that changes. I think inflation volatility, interest rate volatility, will be a bigger driver of performance. So the last generation or generations really benefited equity markets. I think diversification does better here. Okay, so what does this mean? It depends on what your risk neutral area is, but if normally you target a 0.7 beta, over the next 5 or 10 years, I might think more like a 0.6. If you thought that bonds, especially over the last 10 years, were a terrible investment, congratulations, you were right on that, especially over the last 5 years. Maybe it's a time to add some of that exposure into your portfolio. Other thing I want to touch on real quick is there's a lot of stuff going on in the banking industry. I think we all know the Silicon Valley Bank story and hold from maturity bond portfolios. There's another thing out there on the horizon. You guys have probably seen this as well. Basel III Endgame coming to a theater near you. I think that's supposed to come out in 2025. Short version is banks are already quite limited in what they can do in the lending space and in the traditional banking space. That's going to roll down to the mid-sized banks and even to some of the smaller banks as some of the regulations from the financial crisis continue to roll through. So you've got an impaired banking system that opens up opportunities kind of for the shadow banking system. So number one, think about bringing down your equity exposure a little bit. Number two, think about increasing stuff like treasury bonds, TIPS, and precious metals. There's a couple of things to think about. I do it all through derivative markets, so I don't like spending capital on all of those things, but derivatives give me exposure. And then I know everyone is probably tired of hearing this. With the banking conversation we've just had, private credit is really interesting to us. What does private credit mean to us? I'll give you 5 buckets. I'll try to be fast here. One is just corporate lending, so this is kind of like your traditional direct lending space. We stayed away for a long time, but with base rates up to kind of 4 to 5% or more, it really does start to look pretty, if you can get senior secured for 10 to 12 and maybe a point of origination and some exit fees on top of that, it really starts to look pretty interesting. We are seeing fee compression in that space, which we like. Another bucket is securitized. And there's a variety of stuff in securitized. Now that's mark to market, which by and large I don't like being a fully funded pension these days. I don't understand the pricing of AAA CLO tranches or AA CLO tranches. I think you're seeing some repatriation of capital from Japanese investors, which is driving up spreads a little bit. I feel like you're out earning there. Agency MBS is another space. I think you're out earning in that space today. I think maybe that's somewhat related to some of the banking stuff. Third bucket is going to be resi. So, I like residential. I know mortgage rates are up a lot, that's, volumes are down. But land banking for home build, we need housing. This is a global thing, at least in a lot of the, kind of the Anglosphere. There's a shortage of housing across the globe. Is, affordability worse? Yeah, it's worse. But land banking for home builders has been good. And in the UK and Ireland, if you're willing to finance the construction of homes, you can finance pre-sold homes, which is not a bad deal if you're doing it someplace with common law. Commercial real estate, maybe a little bit early, but there's definitely some baby being thrown out with bathwater there. Looking at some like really bombed out, equity tranches of CMBS, and there's a little bit of good stuff and a whole lot of bad stuff. But if you put all the bad stuff at zero and you can monetize the good stuff, there's still not a bad return there. And then on the asset backside as well. So anything that has assets, you can get a relatively modest LTV today, and you're just trying to look to clip at 8 to 10% coupon. So that's a little bit there.
All right, there's probably not much more I can say. So one of the common themes I take from this panel here is interest rate risk. There's a bunch of it out there, and everybody's very familiar with that. But if you go back to looking for us as a pension fund, knowing that we're liability aware, the first thing that we do every year is we go through our strategic asset allocation rework. So the way we do that is we take our estimate cash flows that we get from the actuary from all three plans, and then we'll bump it against the strategic asset allocation framework that we already have today, and we look to see what kind of adjustments need to be made. Now, because of the overlay that we have, we're basically taking about 80% of the interest rate risk out of both the liabilities and the assets. They're better correlated, right? So when you look at interest rate risk, if rates go up, rates go down, we're really only worried about the 20% that's not technically hedged. So really not so much, we're not really that concerned with interest rate risk because of the hedge stuff that we have on. We are looking at potentially, spreads have come in, the lowest they've been since 2004, 2005. So, what can we do there to get, basically take advantage of them potentially widening if you believe that they're going to be widening in 2024. It's anybody's guess. But knowing that they're so low right now, you look at mean reversion, there's probably an opportunity there. So we're talking about that as a team as we go through the strategic asset allocation approach. The other thing for us, if you take a look at our outflows, our benefit payments, they're probably between 5 and 6% of the total value of our plans. And that's in excess of $40 billion. That's a year. So liquidity is not something cool and sexy to talk about, but it's how do you make sure you do all of this stuff and make your benefit payments, they're just under $200 million a month. That's pretty massive. So trying to find pockets of liquidity as we do SAA and as we start planning for next year, it's one of these things that is kind of like underlying everything. In addition to what these guys said, that's really what we're looking at the end of the day. It's stay fully invested, time is your friends. We're a pension fund, we've got lots of time on our side. Stay invested in the equity markets. We've got real estate allocation, we've got hedge fund allocation, we've got a credit allocation, and a small little cash allocation, which isn't bad in what's yielding these days. But at the end of the day, it's really about trying to manage the liabilities, the risk of the unhedged part, and making sure that we have liquidity there at the end of the day. But we're fully invested for the long term, and we believe that the risk premium will pay off. And that's really all we have to do. So it sounds very mundane compared to what these guys are saying, but we factor all that stuff into the SAA process that we do, and we just, we have a 20-year or longer horizon, so we have the benefit of time on our side.
So put the 40 years of being correct in the market with your 20 years, and That's a pretty good horizon. As much as I want to ask Jonathan about tariffs, we're not going to do that, and Stephanie about when the recession is actually going to happen, if it's going to happen. I want to pick up on something that Stephanie mentioned, but I'm going to turn it a little bit. And she mentioned the word valuation. I think that's critical in today's market, and Jonathan definitely gets the prize for mentioning the words private and credit together. So we're going to pay somebody to do that. But in terms of valuations, I want to flip that on private markets. There is a lot of interest in private markets, albeit private credit, private equity, private real estate, infrastructure, even on a more regional basis, perhaps as you're investing more granularly within countries or even within sectors. So let's talk just a little bit about valuations in private markets. Are they reasonable right now? And that's sort of a loaded question. Are they not reasonable? Every single one of you has exposure to private markets in some way, shape, or form. And so maybe we start out with several of you on real estate, several of you on private equity, private credit, and give some different views. Sure.
I think we don't do a whole lot of real estate and real assets. I think, given we have a 70% allocation to equity-like investments, and also given, Ernie said, the long time horizon, we think that equity exposure protects us from long-term inflation. So most of our private market book is venture capital and private equity. Within private equity, all of the data we're seeing is anecdotal, so I can only be anecdotal, I think, about where valuations are. But we're still seeing people paying between 11 to 14 times multiples for things. We ran into someone a couple of weeks ago that paid a 14 times EBITDA multiple for something that had $1 million in EBITDA. And that just does not seem plausible in today's market, especially given where rates are. On leverage strategies, I think we're struggling to figure out how the math works. If your cost of financing went up so much and valuations haven't come down so much. So we think it might be an outcome of so much dry powder in private equity markets. There's been so much money raised over the last decade or so, but I'd say I don't think we have any definitive answers, but it does feel to us that within private equity, valuations are still pretty high, and it might just be where we're shopping and we're not looking in the right places. We do tend to spend most of our time in small market private equity, and again, surprising to us that those valuations have not dropped off. Within venture, we are seeing that valuations on the early stage side and now on the late stage side have gotten a lot more reasonable, and people have taken their hits. And it feels to us that venture kind of acts like a commodity super cycle, like it's a 10 to 12 year cycle. People are real happy at the end of the 12 years, everything blows up, then you start all over again, and it feels like we're there again now. So, yeah, anecdotally, it just feels like things are still expensive in private equity.
Awesome. Ernie, I think you'd mentioned something in a prep session, at least I think it was you, it might have been Muthu, about your strategy for private markets, and maybe explain to the audience about financial leverage versus operational leverage.
Yeah, so specifically when it comes to private equity, I've always been a believer in, trying to stay low turns on leverage. Anybody can do financial. Can you guys hear me? Yeah, anybody can do financial engineering, and that's all great when the markets are good. But at the end of the day, what is really creating value for the long term is the operational prowess of whatever you're investing in. So when we do a lot of the private equity work, yes, we do have, obviously, there's leverage embedded in there, but we try to stay more focused on the operational prowess of the teams that are running all the investments that we have, the knowledge, the experience that they have, their proven track record. And then as the business starts to get better, you can always lever it up, especially when you get out as an exit. But I think a lot of the valuations that we're talking about here, it really depends on the level of leverage you have and the sustainability of these businesses, right? Can they go through a downturn? If you've got low turns of leverage, you should be okay. You can manage through the downturn. If not, you're in trouble. So, I mean, for us, that's the way we kind of focus on it, especially private equity. We try to stay between, keep it low, like between 4 and 6 turns if possible. It's not always possible in every case, but that's it. When we try to go mid-range instead of playing with the big boys out there, we go lower and take a little bit more risk, but you get better terms, you just can manage your investments a lot better. We do a lot of separately managed accounts as well, where we get a lot of say in some of the stuff that we're doing. So that's our approach, and knock on wood here, but, it should hopefully pay off for the long run too.
So maybe I'll turn it to Jonathan and Stephanie, both in terms of valuation as well as what you're seeing in terms of trends in leverage.
Okay, so I heard your first question a little bit differently, so I'll kind of run with that, which is, do you believe, the NAV that managers are reporting to us, and do I think my portfolio is worth what I've got marked on the list for?
Yeah.
Short term, no, not really. So, I mean, just as an example, our private equity portfolio, just in terms of the marks, was up 2% in 2022. So, I think global equities were down 17, 18, something like that. And then in 2023, I mean, we've marked up a little bit, right? So we're probably maybe up 7 or 8% on the private book today, maybe 10%, but definitely trailing what the markets are doing. So that's on the buyout side. I think the secondary markets are actually starting to do a pretty good job of answering this question for us. So as you've seen pricing in the secondary market come down, I think a little bit of what you're seeing is you're seeing kind of this view that, like, if I'm gonna buy into your marks, I think your marks are stale, and you're gonna have to give me a bigger discount on the front end in order for me to, to kind of compensate me for that risk. And so what you'll see is, I think venture capital secondary market's probably pricing in the 60s and 70s. I mean, it depends on the manager and the quality of manager. I don't get super wrapped up around the private equity. I mean, it's almost kind of a feature, right? I like the volatility smoothing over a 10-year period. I think they do a pretty good job. Any individual year, no, I don't think it's probably particularly good. Venture is interesting to me right now because I think that there's going to be a lot of venture companies and a lot of venture sponsors that are going to be hesitant to do like really, really material down rounds. So like venture debt is a space we've really avoided, but with SVB out of the market, and I think there's going to be opportunities for some of these venture firms to maybe look at 10% LTV loans to try to bridge them through until market prices come back. So venture, our venture portfolio is not marked appropriately. All right, there's no auditors in the room. PE's reasonably close. Maybe it's still not quite there. Venture is still overmarked, but it'll work itself out.
Maybe I'll touch on real estate since we didn't touch on that, but I agree on the PE side. I think our clients love the smoothing of PE returns since it's only quarterly, and yeah, you didn't see the dip in PE, and it just kept climbing, but you did in venture. But on the real estate side, I think, if you go back to 2007, the question is it going to be an extend and pretend like 2007, or the banks, going to say, yes, we're not willing to extend and pretend, And so what we're seeing on the real estate side is, there's really no one to finance these properties out there. So unless the bank is doing the extend, you are seeing a lot of trouble with any properties that come up and need new debt. So, but transactions have been very rare. So you're not really getting good pricing in terms of, we all know that real estate prices have gone down because interest rates have gone up as well as cap rates. But we're not really seeing a whole lot of actual declines in the real estate values yet, because there's typically, I think once interest rates stabilize, it's going to take another 12 months. And I think, maybe we're getting to that stabilizing point since the Fed is done. But our approach there has been, more kind of higher in the capital structure, or extending some of that debt since there is no one out there doing that, and you can, really get sort of, again, those kind of mid-teens returns, being the debt for these real estate transactions. And so that's the way we've been playing it. But I do think, there will be opportunities there once, there is no option for debt, and they're forced to sell. So we're kind of waiting, but we haven't seen a lot of that distress play out at this point.
I think that's really interesting. So some of the big funds have very massive redemption queues, and to your point, it's been a waiting period to see how much they can refinance, and to the extent they can't, sales and transactions will start to happen. And particularly within the office sector, as you all well know, that's been a challenge for many, many funds. I'm going to completely change subjects now to something which I found fascinating as we were coming together as a group, and that is how each one of these individuals has structured their teams and their resources, and it's somewhat different from organization to organization. So maybe we spend just a couple moments on the resources you have available, where you see some opportunity to bolster those resources, and then why you've potentially structured. And I think Muthu, maybe we'll start with you last, because give you a little break, because you're newest into the organization that you've come into, and so I'm interested in what, and I think the audience will be as well, as to how your investment teams are structured and the depth of those.
Sure. So Delta's tried a little bit of everything for a variety of reasons. So around the turn of the millennium, Delta had a great big investment team, 20, 25 people, something along those lines. You had 9/11 and bankruptcy happen in pretty short succession. As Delta went through bankruptcy, they had to make a decision on what to do, rebuild the team or do something different from a governance perspective. They went to do something different. So in 07, they'd win OCIO, completely one of the first and biggest plans to completely outsource the management of the pension. That was 07. You run straight into 2008. And that was unpleasant, right? And it's very unpleasant if you have a high spending rate, which Delta did have and does have, even to this day. So you monetize a lot of those losses at the bottom, and that really, I mean, that starts to bring the economic viability of the enterprise into question. So it was at that point where Delta's CFO was like, you know, we should have somebody in here that really like sweats and breathes this stuff like every single minute of every single day. So they hired me in 2011. You know, one thing about Delta, I don't know how common this is, Delta pays my salary. The plan pays the plan pays for consultants. Delta pays my, you know, and so we've got a unionized plan in there, and the union contracts say like you can't charge salaries through the plan and stuff like that. About 50% of pensions do flow, you know, like salary through the plan. Delta doesn't. So not surprisingly, I did not have a mandate to empire build. You know, because if we can work with helpers and we can run the helpers through, you know, the cost of the helpers through the plan, Delta's got to backstop everything anyways, but you know, they got a 25 to 30 year kind of smoothing function behind that. So I've got a small team. So it started with one. It started with just me. I replaced no one. So it started with one, and where we are today is I've got a 4-person investment team. I'm both the CIO and the head of private markets. I've got a deputy CIO who is also the head of hedge funds and private credit. We've got a director of investments that really helps out my deputy CIO and her asset classes. And then I've got a junior analyst that really helps me, because like, it's hard to, like, meeting notes are hard, right? There's a lot of stuff that's hard. So I need to have somebody that helps me hear things and listen to things and document things and uphold fiduciary standards. So 4-person investment team, 2-person operations team. I've got a director of operations, and then he's got somebody that helps him. So 6-person team. We work with and pay a lot of money to helpers, because you know, big allocation alternatives, right? So we've got a helper in private equity and private real assets. That's expensive. Primary, secondaries, co-invest. Those last 2 really expensive. And then we've got a helper on hedge funds and private credit. So we pay a lot of money, but you know, they do a better job of covering the universe than my modest team could.
All right, so opposite to John, he's probably thinking I'm an empire builder.
Ernie's world.
So the plans for us, they pay the salary of my team and I. And we do, I mentioned we have the 3 big plans in the US, but we also have some Canada exposure too, which we added during COVID. And we're doing a very similar liability-aware approach there too. In addition, we do a little bit of DC in Canada with the DB Canada team. So all in all, we're about 33, and we still have some open positions that we're hiring for, but they won't grow more than 33, it'll be 33, and it'll probably be that way for a while. The way we kind of work is, you know, it's kind of like an OCIO, but within the company, because the company does not pay my salary. The plans do. We're beholden to the trustees that we work for at the end of the day. And we do have 2 union plans, which they have their own consultant that represents them, and we work with them quite a bit. And then we have a management plan. So, and that's, you know, so it works out pretty well. Sometimes there is a little bit of an issue. Are you working for UPS? Are you working for for somebody else? What are you doing? Kind of thing. So there's always kind of a little straddle that goes on there at the end of the day. But the team itself, we hire from outside of UPS. They're all investment professionals. They come from the industry. Many of you know who they are. And when they leave UPS, they'll go back out into the industry as well. So it's a team of very well-qualified professionals that just manages these assets every single day. That's all they do. When we have to prepare trustee reports and stuff like that, that's probably the low point of everybody's work. But at the end of the day, that's what they like to do. And the other thing is we're structured we have specialists in every asset class. So we talked about private equity, specialists there, real estate specialists there, public equity, fixed income specialists there. These guys will live, eat, breathe, and grow in that asset class for a very, very long time. So that's kind of how we're structured a bit. We're also, when it comes to working from home, I know that comes up quite a bit since we talked about commercial real estate a bit. We do come into the office about 3 days a week. That's kind of the policy of UPS. But we're not there 9 hours a day. We'll come, maybe 4 or 5 hours. We'll sit together as a team every now and then. But each one of the individual teams, they work on their own, and we're kind of very autonomous when it comes to that perspective. When we moved from growth to liability aware, it was during COVID, and that was a massive shift for us. It was completely growth oriented, and now you're putting a duration overlay, you're changing the composition of your fixed income. We're reallocating, the sub-allocations with every one of the asset classes. That was massive, and we did all of that from home, every bit of it from home. As a team, we get together 11 o'clock every morning. And we'll talk about whatever's going on in the markets, whatever IC memos we have to approve, whatever. Sometimes we'll just talk about other stuff at the end of the day. But we're very, very connected, and we actually were more connected during COVID than we were when we were in office before that. That's kind of weird. So we've kind of maintained that ethos where we stay connected all the time. We meet every day. We talk about what needs to get talked about. We'll approve investments. We'll redeem whatever it is that has to be done. Strategic asset allocation, and we're always on top of it. That's all we do is we talk investments all day long. So I don't know if that helps, but that's the way we're structured.
And there's certainly some variability around this, but Ernie's model is probably 50 or 60% less expensive than Delta's model is.
Now that's a good point. So we had done a cost benchmarking study. CEM is a firm that we used. We contracted them specifically to take a look at everything that we have. So even if you look at all the private stuff that we do, the cost for us, the cost to serve basically, our fees and everything were much lower than our peer group. Our peer group is about 16 companies, the bigger DB plans that are in the world today. But we're on the top decile of cost, and that I attribute that to the good team that we have. If you don't have the knowledge and experience, you can't drive that fee down. You can't get the net value add the right way. So in my opinion, insourcing it, if you have the right team and the right structure, is the best way to go.
So our team, it's kind of built up over the years, but we have 10 individuals, including myself, and we are, asset class specific. And I tag team with all the different analysts to, make sure no one's in a vacuum. And then we also collaborate as a team, and we put our recommendations up to our investment committee, which is, senior members of our organization, CFAs, and that's a very spirited, robust debate. A lot of back and forth in terms of, what our recommendations are, and a lot of kind of testing the waters. So that's an extension of our team. I will say in terms of, how we've evolved over the years is, before we were just ETFs, mutual funds, now we have some strategies in-house, whether it's direct indexing, because we are taxable investors for the most part, or our dividend growth strategy. And, a lot of clients bring in individual stocks, and we want to kind of integrate them. We don't want to, we want to make thoughtful choices in terms of, what we're keeping, but we also don't claim to be some stellar stock pickers. It's more a preference to have individual stocks. And then I also mentioned, that we build individual bond portfolios. And the idea around both of those is, costs matter in the investment business, and if we can eliminate a lot of these costs by doing things internally. That's definitely something that we aim to do. On the private side, since, our clients range from, say, $1 million to $1 billion, in that range. So there's, the whole range. And so for our typical client, that's really in that, say, $5 to $10 million range, they're going to use our fund of funds. But then for our larger clients, they're building fully customizable portfolios on the private investment side. So we've bolstered our resources on the private side. We've recently made a number of hires to just kind of round things out, to have additional support in all these different areas. And, our group, while we don't have any client responsibilities, we often go to investment meetings if clients want to dig in, or, prospect meetings. But our focus is investments, and that's what we, come to do every day. From a work from home standpoint, I will say that we were quick to get back into the office, and I think that stems from, the top of the organization wanted us there, and so that's what we did. But I will say that, we're flexible in terms of if you need to take care of stuff, go take care of it. But I do like kind of the collaboration and just bumping into people, running by things is helpful. And we hired one analyst pretty recently that was fully remote, and they couldn't stand any longer. So they wanted to come somewhere where they could actually see people. They were tired of working out of their bedroom for the last 2 years. So it's worked out well.
You found the
but,
unicorn, by the way.
Flexible.
I said you found the unicorn, by the way.
Probably. And I mean, I think flexibility is the key right now. But I also think, you want to like the people you work with, and it's hard to form relationships through a screen. So.
Maybe also, you're right, we have made changes to how we do things, and so I joined about 1.5 years ago, and maybe before I talk about the changes, it's useful to talk about why we made the changes. So, we fundamentally believe that performance is an outcome, and we think it's an outcome of an apt investment philosophy operationalized by a rigorous process that's run by skilled, aligned people. So when I came in 1.5 years ago, it coincided with, I think, what John had mentioned in terms of a shift in economic regime. So I think we recognized that we're going from a world of globalization, low inflation and low rates, to one of deglobalization, higher inflation and higher rates. So we really had to go back and think about our philosophy and say, do we need to make changes to our investment philosophy and how we do things? And the result of that was to say we needed more dynamism in our asset allocation framework, that we needed to more rigorously analyze relative value between asset classes. So we ended up collapsing 9 asset class components into 2. Equity-like investments, like I said, where all the equity type of investments compete for capital, and then the fixed income-like investments. So that led us to also collapse the team from being siloed to being generalist. And we think that there's power in being an allocator because you get to see all the dots, and there's some power in being able to connect the dots at the end of the day. But process-wise, it kind of feels like organized chaos, because generalist is great, but who does what and who does how and who looks at what, who's responsible for not seeing a deal, and it is organized chaos. And I think at the end of the day, what we try to do is build a culture that supports that organized chaos. So it's about building a culture of trust and building a culture of collaboration, and also building a process that supports those 2 things. So the way the team is structured right now, we have a senior managing director, 3 directors, investment managers, and analysts. Everything that we do has to go through all 3 directors. And generally, the last kind of due diligence meeting, all 3 generalist directors are in that room, and it has to pass muster in all 3 of them. We all travel together a lot. So we're on the ground. It's never 1 person or 2 people. It's usually 3 or 4 people that go and travel together. So we're really kind of connected at the hip. And in terms of thinking about who's responsible for what, the investment manager level folks are a little bit more specialized. So we have one person that kind of focuses on private markets. And we're looking for another to focus on public markets. So if anybody has those folks, please let us know. And I think the biggest thing, you know, as a generalist team, the biggest thing that we worry about is blind spots. So the way the team kind of functions on a day-to-day basis, every director has a coverage list, which is managers that are in the portfolio today. Every manager, every director has a tracking list, which is folks that we're proactively talking to. And every director has a research agenda, which is a topic that we're trying to get smarter on. So that can be AI or life sciences or whatever it might be. And the way we kind of phrase that to our investment committee is that the coverage list make sure that the team's focused on today, the tracking list make sure that they're focused on tomorrow, and the research agenda make sure that we don't get blinded.
There's so many questions I want to ask. But most importantly, your team of 3 or 4 is making Jonathan's company very happy when you're traveling together around the globe. So that's great.